feeling maybe a bit buried under that mountain of financial information out there, constantly searching for those truly actionable insights, but without drowning in data overload. You are definitely not alone. Today, we're embarking on a deep dive into something that honestly looks set to reshape how you make investment decisions. We're talking about how AI is becoming your next sophisticated investment advisor, specifically focusing on what are being called AI teams. Now, our journey into this fascinating subject is guided by some really compelling excerpts from AI Teams, Wall Street's Next Investment Advisors. It's by Azmat, published very recently, July 9, 2025. So our mission today is to unpack how these multi-agent AI systems are, well, fundamentally transforming financial decision-making. We want to offer you a genuine shortcut to being truly well-informed. We're basically here to extract the most important nuggets of knowledge and insight directly from the material, all tailored for you. And here's the really powerful idea about AI teams that we'll be exploring. It boils down to this: human-level intuition minus human-level fatigue. What does that mean?
Well, these AIs can think with the insight of a human trader, but crucially, without any of the bias or the stress or, the need for a coffee break. Remember, once upon a time, the daily market rundown arrived on paper. You'd skim a few charts, maybe catch a closing bell segment on TV, and then make a decision that, let's be honest, felt like 40% data and maybe 60% gut feelings. A huge shift, isn't it? Well, stockbroker would just be baffled. So how exactly is that whole ritual being completely rewritten by AI now?
Yeah, that familiar ritual is being totally transformed by this new breed of digital analysts. We're really talking about an entire multi-agent crew. They're fluent in human language, but also, steeped in all that technical lore. And they sit there ready to debate everything from Fibonacci levels, those key price points, right, to sentiment shifts and earnings whispers, all in real time, their collective output. It's AI stock prediction that sounds, well, eerily like the reasoning of a seasoned veteran trader. Now, this shift didn't just happen overnight. It really crystallized when large language models, LLMs, evolved. They went from being, let's face it, clever autocomplete toys to full-on reasoning engines. But the truly crucial moment, it was when they started having conversations with each other. That's when the whole idea of a single sort of one-size-fits-all robo-advisor started to look pretty quaint. I mean, why settle for one bot when you could effectively hire an entire bullpen of specialists? And this is exactly where systems like, say, Elliott agents come into the picture. Their different components argue, validate, and refine analyses until this comprehensive report just lands on your screen.
That's such a vivid picture. Azmat's book even has this quote from a quant friend who test drove the prototype. He said, "It feels like watching junior analysts hash things out after hours, except the juniors never need coffee breaks." That really captures the essence of this shift, doesn't it? We're moving from those raw, maybe somewhat opaque price action algorithms to these chatty, role-playing crews that deliver insights in clear language, often with these beautifully annotated charts. But okay, does this kind of chatty role-playing AI ever get it wrong? I mean, where are the potential pitfalls here? And if these digital analysts are so powerful, why not just have one super AI? Why do we need this entire team working together?
That's a really critical point. Look, while a single LLM can definitely write a, passable market note, markets have this nasty habit of punishing half-baked logic relentlessly. This sort of iterative tussle between bulls and bears, it really demands a chorus of voices. You need a news digester, a technical analyst, a macro strategist, a risk manager, all these different hats. A system like Elliott Agents mirrors that dynamic. It assigns each role to a separate LLM instance, feeds them a shared context, and then basically lets them debate the market. So it's not just about raw intelligence, it's about the diversity of perspectives, much like a human team. Let me give you a quick rundown of the typical crew, their roles within a system like Elliott Agents. Think of it like a well-oiled investment team, right? Each specializing. First, you've got the data engineer. That's your meticulous research assistant. Cleans, normalizes the raw market, tick data, candle feeds, whatever. Gets the numbers ready. Then the wave analyst, this is your pattern recognition guru, spots those Elliott impulse and corrective patterns, outputs annotated charts with the waves numbered. You've got the back tester, acts as the tough auditor, runs reinforcement learning checkpoints basically. The AI tries strategies, sees what works, and delivers those crucial win-loss stats per pattern, per time frame.
Ruthless, you mentioned.
Exactly. Then there's the technical synthesizer. Merges things like RSI, moving averages, wave data, provides probability scores for different scenarios. The investment advisor crafts the final plan. Price targets, stop levels, all in a human-readable summary. And finally, the report writer just packages it all up. PDF, HTML, maybe an email slug.
It really sounds like each agent has a very specific, almost like a specialized unit kind of job. But what happens when they all come together? What's the real magic, that emerges from that collaboration?
Yeah, for investors, the true revelation isn't just, say, better predictions, it's the ability to understand them. That's huge. This collaboration yields three really distinctive payoffs that are incredibly valuable. First, transparency. Every single step is visible. You can actually inspect the raw rationale inside the report line by line. Big shift from those old opaque models.
That's key.
Second, error catching. If one agent makes a, let's say, wild claim, it gets challenged by the others, and the research specifically mentions the backtester is particularly ruthless here. It quickly flags strategies that just don't hold up historically.
No.
And third, context memory. They have this shared dynamic context. It allows the team to recall a pivot high 2 months back without recomputing every feature, saves time, makes it smarter. So unlike traditional black box models that just, spit out numbers, these multi-agent LLMs, they narrate. And investors genuinely crave that story. Why? Because it allows you to judge whether to trust or ignore an alert, a forecast. It's really about understanding the why.
And speaking of understanding the why, a big part of this analysis often seems to hinge on concepts like Elliott Wave.
Yeah.
Now, if that phrase sounds like baffling jargon to you listening, don't worry. We're going to break it down simply. How do these AIs actually use something like Elliott Wave?
Right, let's demystify that a bit. Simply put, the Elliott Wave principle describes how market mood swings, from optimism to pessimism in these repeating rhythms. And each rhythm carves out a visible pattern, usually 5 pushes in the trend direction, followed by 3 corrective ripples, like waves on a beach, sort of. If you add Fibonacci ratios to this mathematical sequence, you get approximate targets for where each push or pullback might end. It's essentially a way to map out market psychology just by looking at its price action. Now, this is where machines really leverage the principle. That wave analyst agent we mentioned, it hunts for those 5 and 3 formations. Once it finds one, that pattern becomes a feature that the backtester can score. So, for example, it can answer specific questions like, does a completed 5-wave impulse, maybe combined with a very low RSI, meaning it's oversold, does that lead to a rally 70% of the time on NVIDIA?
Oh, okay. Specifics.
Exactly. The reinforcement module answers that in seconds, then shares the finding with the advisor agent. And what's particularly useful, especially for AI stock prediction, is that these waves are fractal.
Fractal.
Yeah, it just means that the same rules apply on hourly and monthly data, same patterns, different timescales.
Oh, right.
This universality is gold for AI. You can feed in Amazon's 1-hour candles and maybe catch a bullish mini-cycle that plays out in days, or feed in its weekly candles and identify a corrective C wave that might take months to finish. Same principle, different zoom level.
Okay, so large language models, they seem to graduate yearly now, like smartphones, right? Each one claiming new capabilities. With this really rapid pace of innovation, how do you even choose the right LLM for doing AI stock prediction?
Yeah, it's definitely a moving target. Choosing the best LLM, it changes fast. As of midsummer 2025, AsMat's research highlights a kind of short list of the top contenders for AI stock prediction. You've got O3 Pro from OpenAI. Strengths are code execution, long context, solid math reasoning. Best for building end-to-end bots with Python. Weakness, limited native image parsing. Then there's Gemini 2.5 Pro from Google. Excels in multimodal intake charts, PDFs, and it's very high speed. Great for chart interpretation, fusing news with price data, though its outputs can be a little verbose sometimes.
A bit chatty, maybe.
A little bit, yeah. And finally, Claude 3 Opus from Anthropic. Strong on ethical alignment, chain of thought clarity. Best for those explainable research notes that need nuance. Downside, API calls are pricier. But the key here often is what they call an ensemble approach.
Ensemble, meaning using more than one.
Exactly. A system like Elliott agents can orchestrate different models simultaneously. For instance, maybe Gemini ingests the raw candlestick screenshots, GPT-o3 Pro runs the heavy calculations, and then Claude drafts the final client-friendly paragraph. This ensemble approach often gives the best quality because really no single model holds every superpower. Combining them leverages the best of each. It often just gives you better results.
Okay, so this sounds incredibly powerful, no doubt about that. But do I, as a listener, need to be some kind of enterprise-level coder to even begin experimenting with something like this?
No, absolutely not. That's the good news. You don't need enterprise-sized servers or a 7-figure budget to get a taste of this multi-agent magic. The research actually mentions a minimal recipe they call Tiny Elliot, and you can build it yourself using open APIs and free libraries. It even provides Python code, apparently, showing the orchestration of a wave scanner, an RSI scanner, and a language style advisor in under 30 lines.
Wow, 30 lines.
Yeah, it's described as crude, obviously, but it vividly demonstrates the concept, and you can then evolve it, add more agents, push it into AI stock prediction app territory.
That's fantastic news, especially for the non-coders among us.
Right.
But with so many options popping up, how do you even begin to separate the truly useful from the just hyped? I mean, this landscape is growing so fast. Are there ready-made options out there if you really don't want to code at all?
Oh, absolutely. For those who prefer not to code, there's already a bustling marketplace of bots. Lots of options for retail investors. You've got tools like TradeGPT Cloud for fully automated order routing, Finwave Mobile for visual pattern detection, RoboEdge V4 blends signals across different asset types. StarterQuant offers drag-and-drop backtests. OpenSignals gives basic price targets, often ad-supported. Plenty of choices. However, and this is crucial advice, you need to apply a healthy dose of skepticism.
Always good advice in finance.
Right. Many vendors claim they offer the best AI model for stock prediction. You really need to evaluate things like latency, explainability, and data lineage. If a service can't clearly show you how a forecast emerges, honestly, pass. That transparency is absolutely key to trust. Always ask, show me how you got to that conclusion.
Okay, let's get to the bottom line then. How well do these systems actually perform?
Yeah.
In predicting market movements in the real world, or at least in realistic tests?
Right, the Putnam's question. AsMet's analysis provides some back-tested forecasts from the Elliott agent's prototype. They used household tickers: Amazon, Alphabet, Google, NVIDIA. For AMZN, it showed a hypothetical return of 4.4% in 5 days. GOG saw 13.3% in 1 month. NVDA, 17.4% in a long swing. Now, importantly, these numbers are explicitly stated as cherry-picked.
Ah, there's that word.
Exactly, but they beautifully illustrate the workflow. Pattern spotted, validated, executed virtually, then scored. It shows the process.
Those hypothetical returns sound pretty incredible, but you did mention cherry-picked, and that always raises a bit of a red flag, doesn't it, for good reason. What's the sort of realistic expectation for a typical user? How much of that comes down to ideal conditions versus what a human trader might actually achieve with fees and slippage and all that?
That's a fair and really important question. Let's do a reality check on these performance claims based on research. First, pattern recognition accuracy. The original study tested 1,000 different market windows across Amazon, Google, and Intel. Adding a reinforcement learner, that self-learning component improved correct direction calls from roughly 56% up to 74%.
Okay, that's a significant jump from 56.
It is, especially when you remember a coin flip sits at 50%.
Right.
But, and it's a big but, you still need disciplined risk management, fees, slippage they eat into returns. 74% isn't 100%. Second, profit simulation. Yes, a simulated short on Amazon netted 4.4% in 5 days, or a long on Google captured 13% over a month. But remember, backtests alone do not pay rent. Treat these numbers as motivation to experiment, not gospel. They show what's possible under ideal simulated conditions, but real-world trading always throws curveballs. However, the biggest win that's highlighted in the research, it's interpretability.
Being able to understand it?
Precisely. Each forecast includes this bullet list detailing the wave count, the Fibonacci levels, the end-day RSI, upcoming macro events, all the inputs. This transparency literally turns the system into an AI trading for beginners classroom. You actually learn as it predicts. It's not just giving you an answer, it's showing its work. That's the breakthrough.
So, okay, we've talked about the impressive capabilities, the potential, the performance. What are the common misconceptions or the pitfalls we should be aware of? Let's maybe bust a couple of common myths about AI in finance right now.
Absolutely. Good idea. Let's bust a couple. Myth number 1, a bigger model, more parameters always means higher returns. The fact. Data quality, feature engineering, and risk controls matter more than parameter count. It's about the quality of the inputs and the whole system, not just the raw size of the AI brain.
Right. Garbage in, garbage out still applies.
Still applies. Myth number 2, the best AI trading bot never loses. The fact is, even supercomputers crash when the Fed surprises or, some other major event hits. Losses are part of the game. Markets are inherently unpredictable to some degree. AI is a tool, a powerful one, but not a crystal ball. In terms of practical risks you need to watch out for, there's the danger of overfitting.
Meaning it learns the past too well.
Exactly. Training it only on, say, 5 years of bullish tech data. It won't know what to do in a downturn. You need to train on multiple regimes, bull markets, bear markets, volatile periods, calm periods. Latency is another real issue. If a trading signal decays in 300 milliseconds, making a call to a cloud server could kill it. The opportunity's gone. Local models can sometimes help fix this, bringing processing closer to the data source.
Okay.
And finally, there are legal gray zones. Some jurisdictions actually ban fully autonomous execution. So the advice is always keep a human in the loop. AI augments judgment, it doesn't fully replace it.
Fascinating stuff. So looking ahead now, what's the logical next step for these AI teams? Where do you see this technology evolving?
Well, Elliott Agents already tackles interpretability by letting the agents debate internally, which, as we said, is a huge step for trust and understanding. But future versions, as Asmat suggests in the book, could integrate macro LLMs.
Macro LLMs.
Yeah, models designed to read and interpret things like FOMC minutes, follow cross-asset capital flows, maybe even incorporate on-chain signals for crypto portfolios, broadening the context. Imagine an AI trading platform where the same crew tracks stocks, bonds, and Bitcoin in parallel, then negotiates a global asset allocation strategy, maybe in plain chat with you. The research suggests that Horizon feels closer than most people think. It's about creating this truly holistic, intelligent financial co-pilot.
Wow. This deep dive has really shown how these multi-agent LLM ensembles are genuinely changing the game in finance, moving far beyond those traditional, often quite opaque algorithms.
Indeed. And I think the core idea from Asmat's work that really sticks is that markets punish myths. The whole black box approach, which sort of promised this all-knowing system, it faltered when market conditions, volatility regimes shifted. What endures, though, is adaptive reasoning. And these multi-agent LLM ensembles, they embody this principle. They treat AI stock prediction as an open conversation, not a closed prophecy. One agent might be wrong, sure, two might disagree. But a third will test, a fourth will rewrite. The collective system will always learn.
And crucially, this approach isn't about replacing human judgment at all, is it? It's about augmenting it, supercharging it almost. Just imagine your future trading desk. Maybe it's just a simple chat window, and you type in something like, walk me through Tesla's daily chart, highlight any extended fifth waves, combine that with current macro liquidity conditions, and give me 2 risk-managed entry points.
And 30 seconds later, boom, a crisp plan appears. Complete with a probability distribution, maybe a short paragraph in clear English explaining the rationale. At that moment, you're neither coding indicators by hand, painstakingly, nor are you just blindly surrendering to some sealed algorithm you don't understand. You are, effectively, running a conversation with an infinitely patient research staff. So the final thought, maybe for you listening, is this. Whether you choose a commercial AI trading platform off the shelf, or you decide to tinker and build your own microcrew, the tool's true worth, its real value, will ultimately hinge on its ability to explain itself with humility and data to spare. The winning products, the ones that last in this space, they will always be the ones that keep the conversation open, share their backtests freely, and invite you to ask why. That ability to be transparent, to be accountable, more than just raw predictive accuracy, that's what will define tomorrow's trusted partners in this endless, fascinating chess match we call Wall Street.